Hello and welcome to Quidachievius Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quidachievius. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and I'm delighted to be joined by our resident podcast commentator and head of fixed interest, Richard Carter, and welcome Simon Doherty, head of the Quidachievius Managed Portfolio Service. Welcome both. So it has been a busy few weeks for the major Western central banks, with both the US Federal Reserve and the Bank of England meeting last week to discuss interest rates, with the European Central Bank having met the week before. And as we have discussed over the course of the year, central banks have had to walk a very fine line of balancing the need to manage inflation down with the very real risk that maintaining interest rates too high for too long could result in a hard economic landing and push economies into recession. And with financial markets having been waiting, not very patiently, over the course of the year, the Federal Reserve finally announced their first rate cut, with the ECB and Bank of England having done so already in previous months. And as we have approached those interest rate inflection points, we have seen a fair degree of volatility as market expectations of when and how quickly rates will start to fall have ebbed and flowed. And more recently, with that sharp, albeit short-lived sell-off across global equity markets in August, we started to see a degree of nervousness emerge over concerns that rates would simply be cut too late to prevent a hard landing. Whilst the rate cut in the US was widely anticipated, what was less certain was the potential extent of that cut. Now, a 25 basis point reduction would certainly have signalled a gradual easing into a rate cutting cycle, but the Federal Reserve jumped straight in with a 50 basis point reduction last Wednesday to bring lending rates down to 4.75% to 5%. And on hearing that news, what was of particular interest to me was how the US bond and equity markets would react. Would that be seen as a positive move, or would it create a bit of panic that the US economy wasn't in such good shape as expected? Did the Federal Reserve know something that we didn't? And the Bank of England met the following day, and with the ECB having made a second cut the week before, and the Federal Reserve coming in with that punchy 50% basis point cut, it would have been fairly easy for the Bank of England to follow suit. But having made the initial 25 basis point cut in August, the Monetary Policy Committee left rates unchanged at 5%. And whilst the headline inflation remained unchanged at 2.2% in August, just above the Bank of England's 2% target, core inflation remains over 3%, with services inflation remaining stubbornly high. And clearly the Bank of England didn't feel the need to carry out any action this month. So, Richard, having spent much of 2024 talking about when the interest rate cycle would finally turn in Europe, the UK and the US, and markets got ahead of themselves on a number of occasions, it is somewhat of a relief that we finally got there. And as those monthly interest rate decisions came and went, it was beginning to feel like we were being forced to watch a will-they-won't-they rom-com all the way through to a second and unwanted sequel. So, Richard, firstly, what did you make of those interest rate decisions, and how did financial markets react? And secondly, now that we have finally seen rates being cut, and perhaps taking into consideration the accompanying comments from those central banks, what do you think we can expect, or at least should be watching out for as we approach the final quarter of 2024?
Yeah, so, I mean, Andrew, I think the first thing to say, Bank of England move was, as you say, largely expected. They wouldn't do anything, despite the Fed making a fairly bold move during the week. The Bank of England was expected to hold on. So we have got a little bit of a time to wait before they make their next cut, which is fair enough. They're being a little bit cautious. I think that the Fed was interesting because the data over the last couple of weeks, or few weeks to be honest, has not really suggested that the US economy is in a bad shape and that a 50 basis point cut was needed, and that 25 would have been just a ticket. So it was quite a bold move by them. And I think it's interesting what you say about could they have spooked the markets? Do they know something we don't? That didn't happen. They did message it very well that they just want to get ahead of the curve and sort of make sure that we don't see some sort of rise in unemployment. So I think they've done a pretty good job. And we have to say, big picture, we had this big spike in inflation. They've managed to get that under control. Rates are now coming down, and so far it looks like we're on course for a soft landing. So that's all good. I think markets really sort of welcomed it, although bonds to some extent had priced it in. So that is all I think for us to welcome. Looking ahead now, still just over 3 months of the year to go. More rate cuts to come for sure. I think we'll see at least one more from the ECB, another one from the Bank of England, and the market's actually pricing in another 75 basis points of cuts from the Fed, which is quite a lot because they've only got 2 meetings left. Key to watch, as ever, will be unemployment, news on unemployment and the jobs front, as well as inflation. But it looks like we're fairly early on in the rate cutting cycle, so that should be as I say, good news, more good news on the horizon, I think.
So, thank you, Richard. We're also joined today by Simon Doherty, Head of Managed Portfolio Service at Quad Achieveit. And thank you, Simon, for joining us today. And as a regular host of the podcast yourself, I'm delighted to be talking to you today about your day job. So there have been a lot of great developments with the Managed Portfolio Service over the past few years, and it would be great to hear a bit more about that. But to start off, we know that markets have been eagerly awaiting rate cuts, and we're finally getting them. And of course, interest rates being higher the past few years has had a notable impact on key asset classes within investment portfolios. So in terms of investment themes and tactical asset allocation, could you tell us what's been happening within the MPS or Managed Portfolio Strategies in recent times? And with that cycle turning, the US election on the horizon, what are your thoughts on the outlook over the sort of short to medium term and how that's reflected in current positioning? Have you made any notable changes as we enter this next phase?
No, thanks very much, Andrew. And it's very enjoyable to be on this side of the fence for this podcast, I have to say. So, markets have certainly kept us all on our toes in recent years. But if I look at where we've been throughout 2024, we came into the year, obviously, off the back of, a very strong rally in the final 2 months of the year. We have retained what I would describe as broadly constructive outlook for equity markets throughout this year. We've seen the backdrop as being very supportive for active managers in particular, and there have been quite a few individual stock opportunities that have continued to emerge. One thing that we've spoken quite a lot about throughout this year has been the level of merger and acquisition and bid activity that we've seen in the UK, for instance, in particular. And we've certainly been the beneficiaries of, a bit of that M&A activity with approaches for several companies that we've owned. So I think that the backdrop has been pretty positive for equity investors this year. And we've reflected that. We've been overweight, to excuse the jargon, our exposure to equities. Our base case has been that global equity gains in recent times have broadly been supported by strong fundamentals. So solid earnings growth and some good guidance from companies. And we believe that can continue to drive equities higher from here. Now, obviously, the market has been looking very closely at the Fed narrative. As Richard said, we've seen a 50 basis point cut. Do they know something that we don't? I think the market has largely settled on the fact that no, this is a Fed that is looking to continue to ensure a positive backdrop for companies, and I think the current position bodes well for our positioning. One topic, if I look at individual sectors, one topic of discussion throughout much of this year, perhaps unsurprisingly, has been exposure to the large US tech names. They've obviously been so prominent in driving markets higher over the last couple of years, albeit, we've seen a little bit of change in that market leadership more recently. Our view has been that, we're not turning our backs on the Magnificent Seven. We're not, avoiding US tech because we feel that, headline valuations are too expensive or, a wish to be contrarian and say, let's call the top and move on. Had you done that in recent times, you really would have been punished for that. Our base case, again, is looking at the individual companies on merit. We have the ability to do that within our MPS. And these are some of the best companies in the world, and our view is we want to own some, we want to be overweight some of them versus their weighting in the index within the market. And in others, we don't. We want to either be underweight or not hold them at all. So, being very pragmatic and looking at each individual company on its merits has really, again, been a key theme of ours and very much aligned with the investment process at QC. I can't talk about, the Fed or recent positioning without also talking about bonds. And, we've, again, consistent with, and we work very closely with Richard and colleagues, we've been very positive on the outlook for fixed interest investments in 2024 relative to our views, in recent years. We felt that, there is merit in being overweight high quality sovereign debt and investment grade credit. Now, that hurt in the first half of this year. We saw renewed inflation concerns. You summarized it very well, Andrew. The resilient global economy, the continued resetting of interest rate cut expectations all proved quite a headwind for bond investors. But we have continued to stick to our guns. And in terms of more recent activity, we put some more cash to work in bonds, reducing our model cash weights to lock in yields on our expectation that rates are going to continue to come down. And the timing of it is been uncertain, but there's been a lot of merit in ensuring that we continue to lock in some attractive yields for investors. But also, should we see economic growth underwhelm, and at the moment it doesn't look like it is going to, then bonds will provide that diversification benefit for investors in their portfolios. So our positioning has been overweight equities, overweight bonds, underweight cash, and underweight some of the other alternative investment ideas. That hasn't changed since the Fed's moved. And I can't see it changing in the immediate term. We're quite comfortable with that, positioning at this point in time. With inflation falling, it does feel like the soft landing is still on the cards, and that should be a benign environment for our positioning.
Simon, thank you very much for that investment update, and really interesting to hear your comments about the tech sector, which we know has been really prevalent in driving markets and the bond markets and adding that exposure. Simon, there's been a lot of sort of great developments within the sort of managed portfolio service itself, and as I mentioned over the past few years. And it's a service that has gone from strength to strength, and is something that we're very proud of at Quid. So perhaps for those not yet familiar with the managed portfolio service, could you give us a quick overview on how that service has evolved the past few years, and perhaps tell us about any sort of recent developments or future plans that you might have?
Yeah, absolutely. So, we've been running a managed portfolio service at Quilter Cheviot since 2001. It's one of the longest, if not the longest, MPS propositions out there in the marketplace. In 2021, we undertook some, fairly significant changes to the construction of our strategies. So how we are able to build the investment exposures for clients within a model portfolio format. And what we did was to launch a range of funds back in September 2021, which we call the building blocks. Now, there are a range of funds that are designed specifically for use by Quilter Cheviot and designed specifically for use within our managed portfolio service. And every one of our MPS strategies now is constructed using a blend of these 8 building blocks to ensure that we can reflect the investment ideas that we want to for clients. Now, there are a couple of high-level benefits without going into too much detail of this approach. Firstly, it ensures we can be very nimble in terms of wanting to make changes at the underlying portfolio level. So, if we have views that we want to reflect very swiftly in terms of our exposure to, a particular sector, or manage the interest rate sensitivity of our bond exposure, or take advantage of discounts on some closed-end company holdings in the marketplace, we can very much do that now in a very swift, very granular fashion. It also ensures that we can open up the managed portfolio service to reflect the ideas of the entirety of our research capability at the company. So obviously the great work of the investment fund research team, but also the direct equity ideas that you'll have heard on this podcast, are coming through from the individual members of the equity research team. And the final point is also that we can provide a more active solution at a lower cost than we've been able to prior to that. So costs are always a consideration, but we want to ensure that we can reflect our views in a way that is very much aligned with our thinking, and to do so in a very cost-effective manner. So we've looked at the costs of the underlying exposures. We've looked at the headline costs as well of the service. And, pleasingly, we've been able to bring those down in a way that is to the benefit of investors without diluting our conviction or reducing, our views in terms of reflecting active investment ideas. So, there's a lot that's been going on. More can be found on our website. I don't think we've got time to go through it all today, but ultimately what we've sought to do is improve the quality of our MPS proposition, build upon that, 20-year plus track record, and reflect the best of what we do at QC from an investment perspective across that research capability.
Simon, thank you very much for that. And Richard, I just wanted to come back to you on the UK economy. Now, we had an update last week on the Bank of England's quantitative tightening programme, which is the unwinding of the quantitative easing programme that went on between 2009 and 2020 in that sort of post-financial crisis era, where the Bank of England bought up gilts and bonds to support financial markets. Now, quantitative tightening has been going on since, I think, February 2022, so it's nothing new, and that in part has been achieved through selling gilts, but perhaps more so through the natural redemption of gilt issues. But of course, over the past couple of years, interest rates have spiraled, and there is that inverse relationship between interest rate and bond prices. And gilt prices have significantly fallen, as Simon touching upon over the past couple of years. And as a result, the Bank of England will be incurring significant losses on the balance sheet with some of those gilts, and presumably that's going to be paid for by the Treasury and ultimately the taxpayer. I mean, we also heard last week that UK government borrowing reached 100% of GDP in August, which is the highest level out with the COVID pandemic that it's been since the 1960s. And that all comes ahead of the new Labour government's first budget on the 30th of October, and which Rachel Reeves, the Chancellor of Exchequer, claimed to have inherited a 22 billion black hole from the previous administration. It's perhaps no surprise that a GfK report published last week showed that UK consumer confidence in September is pretty low, and in anticipation of what is expected to be a painful budget. So, Richard, there will, of course, be plenty of political rhetoric and sensationalist media headlines in the run-up to this budget. And whilst we can't predict what may or may not be sort of contained in that budget or when any changes might become effective, but do you have any thoughts on those sort of recent updates? Should we be concerned? And do you have any sort of general thoughts looking ahead to the budget and perhaps looking at it from a sort of a fiscal and macroeconomic perspective?
Yeah, I mean, I think big picture, there's no question that the public finances are in a great state. I mean, it depends which sort of measure you take, but obviously the one that showed them sort of 100% of debt, 100% of GDP did catch the headlines. I'd say we're not the only country in this who has this issue. Obviously, the Americans have it, and plenty of countries in Europe do. Partly as a legacy of sort of COVID and inflation, but also because with aging populations and everything, the amount of things that the state are involved in terms of paying for medical services and all the rest of it, and also the cost of the debt, it is quite difficult for governments at the moment, and it is a worry for markets, definitely, as we saw with the whole Liz Truss situation a couple of years ago. I mean, the challenge for the budget, really, challenge for Labour is this so-called black hole. The numbers will probably move around and forecasts can change, etc. But they probably will need to raise taxes, and they're certainly gearing us up for that. But ultimately, the way to have good public services and the way to get the debt down is to grow the economy. And Labour have sort of talked about sort of 2.5% GDP growth would be ideal. The problem is the more they raise taxes, it doesn't exactly encourage investors and consumers and businesses and all the rest of it. So it's a really difficult balancing act for them, to fill this hole, but at the same time grow the economy. And I think definitely going to looking for signs of reform, signs of measures that are going to help us over the longer term, and hopefully the shorter term impact of higher taxes won't be too bad. But as I say, it's a difficult balancing act for Labour, and you can understand why at the moment talking things down and trying to blame the previous government.
Thank you, Richard. And no doubt there'll be sort of much speculation and ongoing media attention in the run-up to the budgets, I think clients will naturally be concerned about how they might be affected, impacted. And there certainly could be implications for the likes of inheritance tax, pensions, capital gains tax. And of course, there's that uncertainty as to when any changes might become effective. So in the run up to the budget, and with inheritance tax potentially a key target for the Chancellor, Court Cheviot will be running a webinar on Monday, the 30th of September at 2 p.m. And our technical tax consultant, David Denton, who many of you will be familiar with, will be talking with Chartered Financial Planner Tracy Cooks, and they'll be having a closer look at inheritance tax and what the potential changes could be and the implications for those currently looking at intergenerational planning. And we'll also be broadcasting a live webinar the day after the budget on the 31st of October. And my fellow investment managers, James Hughes and Jonathan Raymond, will be joined by former Chief of Staff to the Chancellor of Exchequer, Adam Smith, and they'll be dissecting that autumn budget statement and what it will mean for people's financial plans. And you can register for both webinars on the Court Cheviot website. So just before we draw to a close, if any listeners have any questions that they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. And to stay up to date with our thoughts on markets and current issues, please visit our website at www.courtacheviot.com. And here you can also see more of what we're doing at Court Cheviot, as well as signing up for the budget and IHT webinars. And you can also watch past webinars on demand and subscribe to our weekly comment newsletter. So we'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. So thanks again to our Head of Fixed Interest, Richard Carter, and Simon Doherty, Head of our Managed Portfolio Service, and you all for listening.